Oh, okay. I think we are live. Sorry, we are having internet issues at our office today, but I believe that I am in and live. It says I'm live, so hopefully someone can drop a comment or something like that so that I know for sure it's working. Okay, I do now see that we have a couple of views, so thank you so much for jumping on. And I am going to get started here in just a minute. And I am also, okay, good. Yes, thank you. I did just get a comment saying that it is coming through. So thank you so much. Thank you guys for joining. And I am going to take you through some slides here in a second. So I'm going to go ahead and share my screen. Okay. And let's see, view slideshow. All right. I hope this is working. I can no longer see the comments, so hopefully you guys can let me know if. Well, I can't see the comments anymore because I can only see what's on my screen. But I'm sure that Christy will stop me and let me know if no one can see my slide. But I think you should be able to. So this is about mine and Christy's story. We were able to, if you don't know us personally, but we maybe many of you do, I think. But if you don't, we've been, in real estate now for about 11 years and, made some good money and also spent a lot of good money. And, we were in debt and literally just in a very short period of time, we were able to get out of debt and start building up a little real estate portfolio. We still have much bigger goals, but we do currently own 12 doors, most of which we have accumulated over the past 2 years. So I want to take you through our journey, and I'm going to talk to you about each property that we bought, what we bought it for. I want to be totally transparent, and I'm going to share the numbers with you of like, okay, this is one of the properties, this is what we paid for it, this is how we found the deal, this is how we financed it, this is what our monthly payment is, this is what our cash flow is. It's going to be very numbers based because I don't like philosophical discussions. I like to see the math behind stuff, and that's just kind of who I am. So I hope that you'll appreciate that. Maybe you'll be bored to tears, and that's okay. I guess we're just not on the same wavelength. But I only know how to teach this the way I like to teach it, and that's a numbers based. But anyway, if you are interested in connecting with us, these are links to all of our social media and our YouTube channels and our email addresses. So feel free to, I actually have a goal to gain 20 Instagram followers this week for an accountability group that I'm on. So I would absolutely love it if you could go follow me on Instagram. All right. So, what am I hoping that you will get out of this? Well, number one, I think that there are a lot of people who don't invest because of fear, right? There's always this unknown. Well, that sounds scary, and that means we're going to be taking on risk. And I know that every time I've gotten ready to, I think I found a property and I kind of want to invest in it, it still feels scary. If you've ever, I think most people watching this are in real estate. Hopefully everyone is. We really only targeted real estate agents for this. And so if you've ever gone through the experience of like hiring your first assistant or something like that, it's very scary. You're like, okay, I'm used to making, X amount of money, and now all of a sudden I've got to pay out this salary, and you feel like you're taking on this huge risk. At the end of the day, that assistant ends up helping you grow your business, and you end up able to make even more money. But it's really scary in the beginning. And so I think a lot of people don't invest because they're just afraid to take action. And I've got a quote that I really like from Robert Kiyosaki, of course, author of Rich Dad Poor Dad. He says, the biggest risk a person can take is to do nothing. So I really think that there are some good opportunities out there, and sometimes you just have to take action. A little bit of fear is okay. Caution, making sure that you are, making sure that you're investing wisely, but not being, paralyzed by fear. Help you understand that normal people can invest. If you're not in the Phoenix market, if you're in the Phoenix market, you will hopefully already know that there's some good opportunities here. But if you're, we network with a lot of agents who are in markets where you really can't buy cash flow properties unless you're putting 50% down or something crazy like that. And it's really hard for a first time investor to be able to buy a cash flow property. So, if you're in another market, my hope is to convince you that maybe you should be looking at our market for your first investment property, and also consider referring your clients over to us if they're looking for an investment property. We'll talk a little bit about leverage. We'll talk about different types of loans. We'll talk about property managers, all that fun stuff. So I want to start. I'm not going to actually spend a ton of time on our debt journey. We had, I don't know exactly how much it was anymore, but around $100,000 in consumer debt, student loans, auto loans, credit cards. So I know I've met with a lot of people who are in a much worse situation than we were. And here's what I say about it. Number one, don't bury your head in the sand about the debt. Like, just hope it's going to go away. I think sometimes, we're embarrassed to talk about it, and it's an uncomfortable conversation when you're meeting with your spouse, for example, and talking about, okay, this is where we stand, and this is our plan to get out, and sometimes we just want to act like it's not there. So what Christy and I did is we started holding regular meetings. It was at least once a month, but I think it was actually more often than that. It was at least twice a month. We listed all of our debts on a spreadsheet. And we did Dave Ramsey's debt snowball method. I'm not going to try to reteach that whole thing. There's tons of videos on YouTube about it, but basically you just list all of your debts from lowest balance to highest balance, and you make the minimum payments on everything except for your smallest balance. You attack your smallest balance with any extra money that you have until you pay that off. And then you roll the payment that you were making on that into the next one, into the next one, et cetera, et cetera. It is the best way, in my opinion, to get out of debt. I know there's a lot of people who might argue, well, yeah, but shouldn't you pay off your highest interest rate first, or kind of attack it from a math standpoint? But really, our experience has been you need the small wins, paying off those small balance credit cards, or whatever's left on a student loan, or whatever it is. You start gaining momentum, and you start feeling really excited about it. And the other thing is, again, I'm assuming most everyone here is a real estate agent. We are so lucky in this industry that we get to control our income. So we just said, you know what, $100,000, it feels like a lot sometimes when you think about it in one way, but the other way is you just say, we could go out and just blitz it and work our faces off and sell a few extra houses above what we would have normally done. And that alone will give us nearly enough money to pay off all of our debt. So let's just really focus on working really hard and going out there and getting that stuff paid off. So that was kind of our getting out of debt journey. And after that, we just became obsessed with building passive income. We have a big goal. We want to create $20,000 a month of purely passive income that would never go away. I know obviously there's other sources of passive income that you might get from a business, or from for example, revenue share, profit shares from real estate brokerages. But there's possibility that all of that could go away. And I kind of feel like, with real estate, I don't think everyone will always need a place to live. So if I can create $20,000 worth of passive income per month on long-term rentals, I feel like that will never go away. People will always need to live. In fact, most likely it will grow at a pace that's even faster than inflation, which of course is a big conversation right now, inflation and all that fun stuff. I like the idea of vacation rentals on paper. I'll talk about it at the end, but we probably are looking at doing a vacation rental soon. But I was intimidated by the cost of having to furnish it, and then the amount of work that has to be done to manage it. And it all just felt like too much to me. And I just wanted mailbox money. So I focused initially on long-term rentals. Not to say that I think short-term rentals are an awesome vehicle. It just wasn't for us at that time. We all have these stories in our head about why we don't, why we do what we do, or why we don't do what we do. And one of mine was, well, At one point, we had a really bad experience on one of our, for the first house we ever bought, we turned into a rental. And, I'm not handy. I don't know how to fix anything. I'm really nice. I tend to let tenants walk all over me if they're not paying their rent or things like that. And yes, Christy? I think the internet's going to run at 10. I'm using my hotspot. You're the best. Yep. I can't see the comments, so I need you to help monitor comments and things like that because I'm sharing my screen, so I can only see my screen. I'm on the comments. Okay, great. So Christy is monitoring the comments, and if you have questions or anything like that, post them in there, and at the end, I will go through and make sure that I address all the questions and comments. So I kind of had to overcome some of my own self-doubts and and things like that. One comment that I would make about rents, I think that there is even in my own head, this worry that our market is just out of control right now. Prices are so expensive. I mean, in my opinion, there's no sign of letting up. Like the inventory is so low, there's basically no way. And almost regardless of what happens with interest rates, I just don't see a scenario where home values are going to drop anytime soon. But someday they will, right? I mean, there's no way that forever home values are just going to continue to go up forever. Like at some point, there's going to be a dip, and part of me wants to like time that dip. I'm sure you've heard though the best strategy in the long run, right? Real estate values never go down, right? There's be dips, but it always recovers and always goes up over time. But the more important thing, in my opinion, on that is, oh, I'm sorry. The quote that I'm sure you guys have heard. Oh, I don't know if it's a quote or more like a proverb or a saying. Don't wait to buy real estate. Buy real estate and wait. So I love that. I try to remind myself of that. Like, you know what? As long as I can buy a property that has positive cash flow today, it doesn't really matter. I mean, it matters. You want the value to go up, but if the value of the property goes down, that's just on paper. It doesn't matter what the value of the property is until you sell it, right? So what really matters is if I can buy a property and have positive cash flow on day one, I believe that I will always have positive cash flow on that property because rents virtually never go down, right? I mean, just look historically, average rents, even in the Great Recession. I mean, maybe some little submarkets, but even in the Great Recession, Phoenix was one of the hardest hit markets in that, average prices dropped by over 50%. Every house got cut in half. Rent prices stabilized. Like they didn't really fall. Average rents basically stayed where they were. And so if you can buy a property, regardless of what what you might be able to sell it for, it doesn't really matter as long as you've got positive cash flow. So, all right, now I'm going to take you through again. I mentioned I wanted to take you through each house that I've bought. I'm going to summarize all of this in a spreadsheet here towards the end. But this was our first property that we bought we actually bought that we currently own. That's a rental. We actually bought this as our primary residence. We lived in Rio Rancho, New Mexico. It's in the Albuquerque metro area. We lived there for a brief, not even 2 full years. So when we bought this, we used an FHA loan. We put 3.5% down. We paid $225,000 for it. Today, it's worth about $325,000, and it creates about $600 a month in cash flow. The reason that I bring this one up, maybe you guys might think, well, this isn't really a true investment. You bought it as your primary residence. Well, the reason that I bring this one up is this concept, and hopefully you're all already familiar with it, is called house hacking. Well, house hacking is used in several different ways now, but the first way I heard of house hacking is when you buy a house as your primary residence and eventually turn it into a rental. And if you are not married to the house you're living in, this is one of the best ways to start building your rental portfolio. Is you buy a house, you live in it for whatever period of time, and then eventually turn it into a rental and go buy the next one. There's several huge advantages to doing this. The biggest of which is that you can buy the house for way less money out of pocket. I would say that's probably one of the biggest objections that I get about why people don't invest in real estate is they have trouble coming up with 20% down on a property. And so if you can buy a house for 5% down, well, then you can buy more houses than if you had to put 20% down. But you do have to actually live in them. I don't want you to go commit mortgage fraud or anything like that. You do have to actually live in them. But you could live there for whatever, a year, and then turn it into a rental and go buy another property. Also, you get a better interest rate when you're buying a property as a primary residence, as opposed to an investment property. So some big advantages to doing that. This is actually our current house that we live in. I bring it up not because it's a cash flow property or an investment, but it is going to become relevant in a minute, and you'll see why. So, we actually bought this property in 2010 for about 288,000. In early 2020, when COVID was hitting and rates got just insanely low, we were able to refinance. We pulled $150,000 because again, we bought in 2010 at like very bottom of the market for the Phoenix area, and we did pull out $150,000 worth of equity, and we used that money to buy more rentals. Now, I know that there might be people who like just really Dave Ramsey in particular who would just really disagree with that strategy. But here's the deal: we were focused on cash flow, and because we had a mortgage, that had mortgage insurance, and we were lowering our rate by more than a full percent. Pulling out the 150,000 actually only increased our monthly payment by about $200 a month. We leveraged that 150,000 to buy 3 rentals, which you're going to see in a minute. And those 3 rentals produce over $1,000 a month in cash flow for us. I know that this, again, I might not be mainstream on this, or maybe this really goes against the grain for you. But for me, I don't know if it ever makes sense to pay off a mortgage that has a rate in the twos. Especially when you can write off the interest and when you can leverage your money to create a significantly higher amount of cash flow, right? I could pay the house off, and now I don't have access to that money anymore unless I sell the house or get a new loan on it, which of course I'm going to pay all these fees on. But when inflation, I think I saw an article yesterday that inflation in January hit 7.5%, and you're able to borrow the money on your house at 2 point something or 3 point something, and you're able to write that off on top of that, and you're able to leverage that into additional income. I think it's a no-brainer. So rates have gone up a little bit now, and I can't speak for you whether or not it would make sense, but it is what we did. And so again, I'm just showing you the story of what we did and how we got to where we are. So one of the first houses that we bought basically with cash out refinance is this home on Sunflower. This one was really interesting the way it came to us. They say great investors never pass up a deal, right? They'll find a way to get it done. Well, we were working with a client. They were actually a Zillow lead, and we were helping them buy a house, a different house, and they were selling their old house to OfferPad. If you're not familiar with OfferPad, they're an iBuyer like Open Door and like Zillow used to be in our market, and they're in a bunch of other markets, but they actually started in Phoenix. And I told them, I was like, listen, we can get way more money for your house. They were selling their house to OfferPad for, 217. And I was very confident that I could have gotten at least 240 for it. But because of health reasons, and they had all their own reasons, they did not want to sell the traditional way. They were happy making way less money on the sell their house to OfferPad. But then COVID hit, and OfferPad canceled, and so did Open Door, and so did Zillow. They basically canceled all their contracts with everything that wasn't already about to close. And so that meant that, again, I was working with this client, helping them buy another house. Well, that meant that deal was going to fall through too. So I went to them and I said, hey, it just so happens that I'm in the process of trying to buy some investment properties. And if you'll give it to me for the same price as what you gave it to OfferPad, I'd be interested in buying it from you. And so we did. We bought it in May of 2020, which was really cool because we were also saved the deal on the house they were buying. We did put 25% down. We paid 217,000. But one cool thing about it is that we did charge, I believe it was a 5% commission plus 2% in closing costs. On non-owner occupied loans, usually that's the most you can get in concessions is 2%, which again, we structured it so that the net to the seller was the exact same as the way it would have been selling to OfferPad. So we were getting this house well below what I thought fair market value is. I also really loved that this house was built in 2019. So I love buying newer houses because I know that I'm not going to have to replace the roof or the air conditioner anytime soon, which of course are usually the biggest expenses that we have on a house here in the Phoenix area, roof and air conditioners. And, when you have to replace the roof or an air conditioner on a house, it could wipe out all the cash flow profits that you had on a house for a couple of years. So that's one of the things I love about brand new construction. So it currently rents for 1,700, but actually that lease is coming up in about 2 months. And I was just looking at the comps for this house yesterday, and it's now up to 19. Not currently. The comps support a rental price of 1,900. So I'm getting 1,700 right now. I'm about to be getting an additional $200 a month on that property. Now we'd really caught the bug. We were really excited about investing. And this next property, and I really bring this one up because we bought it off the MLS. This home was just an MLS listing, but it was tenant occupied, and the tenant wasn't very cooperative with showings, and it didn't show great. But it had the types of things that I like. It had all tile flooring downstairs. It had very little carpet. It had low maintenance landscaping. Like, it had the type of things that I really like on my rentals. A little bit of an older home. I think it was built in 2004 or 2006. But yeah, right off the MLS, we closed on it in December of 2020. We paid $182,000 for it. Plus, of course, we received some of the commission back on it. We did put 25% down. It rented in under a week. The mortgage payment on this, again, we only paid 182 for it, and then we put 25% down. One great thing about Arizona is we have some of the cheapest property taxes in the country, and it also does not have an HOA. So my total payment on this house is $750 a month, and it currently rents for $1,650. The best part is that its current value is $275,000. So in just over a year and 2 or 3 months, we've gained $100,000 in equity, and we're also making $900 a month in cash flow. Then the next property that we bought was actually a duplex. Well, the interesting thing about this duplex is we actually put an offer on this property before 7th Street, but we didn't get it. They went with another offer. Then that contract fell through, and they came back to us and said, "Hey, are you still interested?" Well, the problem at this point is that I already had this property under contract, and I didn't think maybe I could have got it done, but I did not think I would qualify to try to buy both houses at the same time. I needed to close on 7th Street, get a renter in place to offset my debt to income ratio. By the way, I'm using all Fannie Mae, Freddie Mac mortgages on the property so far. So I wasn't doing any portfolio lending. I really wasn't even exposed. That really wasn't even part of my world at that point. I didn't even know that much about it. And so I wish maybe knowing what I know now, maybe I would have just got a portfolio loan on it. But anyway, because it was already fully rented. At the time, it was only renting for $1,200 a month. But we used a hard money loan on this one because I really wanted it. I thought it was an incredible deal, and so yeah, we went ahead and bought it. We paid $168,000 for it. We also put 25% down on this one. It again, no HOA, super cheap property taxes. The property taxes on this duplex are literally $700 or $800 a year. So very, very low. It was renting for $1,200 a month. Each unit was $600. So the front house and the back were both renting for $600. We raised the rents on both to $800 a month. So now we're getting $1,600, and our mortgage payment is literally $650 a month. Currently worth about $275 easy. I actually wouldn't be surprised if I could get $300 for it, but I'm not selling. Not with that kind of cash flow on it. So and then the next one that we bought was a new construction home. There's a lot of things I love about buying new construction. I already mentioned, not having to worry about maintenance issues, roof and air conditioner and those types of things. But the other thing I really love about new construction is that, at least in our market, you can lock in the price, and they're going to take 4 to 6 months to build it. But the price was already locked in at the time of the contract. So the value of this property went up. I mean, of course, the market has been crazy. We all know it's been bananas, and I know it's not always going to do this. But this property gained about $50,000 in equity before we ever even closed on it. So we closed on it in January 2021. So we literally only owned this house for a year and a month. We paid $231,000 for it. We put 25% down. Our mortgage is $1,100 a month. It rents for $1,700 a month. So obviously the cash flow on it's not as good as the duplex. But again, I love that it's a brand new house. Something that I feel like, I mean, here's the deal. In our market, I can't speak for everywhere, but in our market, most of the duplexes and triplexes and fourplexes are not in the nicest neighborhoods, right? So I kind of like the idea of having this mixed portfolio where some of the properties that we own are, maybe not the most beautiful areas and neighborhoods, and some of them are. And so yeah, this house, again, we paid 231. It's easily worth 315 today. Um, and we again, 50,000 of that was gained in while it was being built. One of the ways that I talked Christy into doing it, because I think she was getting nervous here, we're accumulating all these properties and all this debt all at the same time, was I was like, look, even if we have trouble renting it, or even if it doesn't end up being as good as we think it could, we could just turn around and sell this property. Worst case scenario, we could turn around and sell it and at least break even. That's how confident we were in the direction that the market was heading when we put this under contract. Obviously, looking back, we could have bought it and sold it for a huge profit. Someone asked a question: how did we choose to put 25% down on some of these properties instead of 20%? Well, at the time, I was really rate focused. I wanted the best rate possible, and with how low purchase price these properties were, I felt it was worth it to put the extra 5% down to get a better rate. I don't know how much better exactly it was, but it was around somewhere between an eighth and a quarter of a percent better to put 25% down. And again, we had the cash from the refinance of our house. Looking back, I almost wish I would have put 20% down on them, because they all have such amazing cash flow anyway, and bought another house, right? Because if you put 25% down on 4 houses, well, that means you could have put 20% down on 5 houses, right? So, or did I do that right? Yeah, I think I did that math right in my head. So looking 20, but I wouldn't say I regret putting 25% down. It's just the way we decided to structure it at the time. I wanted a very awesome rate. Then we were kind of out of cash for a little bit, had to save up a little bit more money. And then it actually wasn't really even on my radar, but I got contacted by a wholesaler about a fourplex that was for sale. And I just couldn't believe the numbers. I was like, how is this property how are there not like 1 million people trying to buy this property? And so we paid $335,000 for this fourplex. Now, I do want to point out a couple of things on this one. First of all, the wholesaler had to close fast, so we again had to use a hard money loan to buy it. And then I would also like to point out that this is a C-level property. It's not an area that I would want to live in, but the cash flow was just insane and very, very low maintenance. And so basically we paid $335 for this property. By this time, I was more focused on trying to accumulate more properties rather than putting more money down. So Mountain America Credit Union, they're not all over the country. They're in Utah, Arizona, Idaho. I think they might be in Nevada and 1 or 2 other states. So basically in this Rocky Mountain area, shall we call it? I guess Arizona is not really part of the Rocky Mountain area, but you get what I don't think they are in. I don't think they're in California or most places yet. So I'll answer the hard money loan question in a second. But this time I wanted to preserve capital so I could buy more properties. So Mountain America has a unique loan program where you can buy a non-owner occupied with only 10% down. And it has no mortgage insurance, and the rate was 3.6% or something like that. So insanely good rate for a lower down payment, non-owner occupied. The catch on it is that it's amortized over 30 years, but it has a 15-year balloon payment. But I kind of felt, you know what, 15 years, I'm pretty sure I'm going to want to get out of this property before 15 years and do a 1031 exchange. Or worst case scenario, I will do a refinance into a traditional mortgage once I've got a little more equity in the property. And so our mortgage payment on this property with that loan is $1,500 a month. Now, when we bought it, it was renting, all 4 combined units were renting for about $2,400 a month, which again, I felt was below market. So I think a lot of investors were just looking at, well, the cap rate based on $2,400 a month wasn't fantastic. If you don't know what cap rates are yet, I'm going to explain that here in a minute, and we will go over that. But again, once we got it, we went in there and raised all the rents. We're currently getting $3,400 $450 a month. And it's easily, again, we bought it from a wholesaler, which, I believe we got it well below fair market value. I've got its current value pegged at 375, but honestly, that might be super low because there's another fourplex for sale less than a mile away, similar year built, similar quality, and they're asking 450. It hasn't gone under contract yet, but I kind of got my fingers crossed that if that one sells anything close to 450, I could probably refinance it now. The best part about this property was that we partnered with our amazing operations manager, who's been with us now for, I think, 4 or 5 years, and she's a great friend. And we helped her buy her first house a couple of years ago, and she was actually already in the process of doing a cash out refinance for some home remodeling projects. And I said, hey, do you think you'll have a little bit of extra money laying around? Why don't we partner on this deal? So we partnered on it together. And that to me was the most fulfilling part of this, because now, it's not just my investment journey, but helping our people and our circle start to build wealth through real estate as well. So that was really amazing. And so obviously the gross rents currently $3,450 a month, mortgage $1,500 a month. So we're getting almost $2,000 a month in cash flow on that property, which we split. So almost $1,000 a month each. Then we bought another new build. Oh, I'm sorry. I need to go back and answer a hard money. Okay. So a hard money loan is a lender who it's a private, usually a private company or a private individual they have cash and they will lend it to you, usually for a fairly short period of time, so that you can buy real estate. And they have types, some loans that they'll do and some loans that they won't do. But hard money lenders love lending money on cash flowing properties, because they basically have a clause in there that says, hey, if you don't make your payment, we can cease the rents and we can start making the tenants pay the rent to us. So they don't have a ton of risk on the line. And they come with a really, really horrible high interest rate, usually 10 to 12%, depending on your down payment, depending on your other assets. And, but you don't need to do tax returns. You don't really need to qualify. You're basically coming in with cash. So you go to the hard money lender, you say, hey, this is my situation. And they say, okay, great. I'm going to charge you 12% interest to do that loan. But if you want to do that, here's my money. And obviously, you would not want to stay in a hard money loan long term. We refinanced this particular hard money loan just a little more than 30 days after we bought it. So we really only had to pay one payment at the 12% interest. And again, that payment, the rents basically covered that payment anyway. So it didn't really cost us much. Now we had to pay the refinance charges, but you would have paid closing costs on a traditional loan when you're buying it anyway. So I think it all ended up working out. If you have an opportunity where you have to be able to close on a property fast, or it has to be cash, or it won't qualify for financing because it's in such bad condition, home flippers, for example, often use hard money loans. It's a good option. Definitely not the type of loan that you're going to want to use to be in a property long term. Then we bought another new build. Again, you've already heard my spiel about why I love new construction. We actually just closed on this one in December of 2021. We paid $231,000 for it. We put 20% down on this property. Our mortgage is $1,100 a month, and it currently rents for $1,700 a month. All of our rentals, by the way, have rented in like under a week. So it's not like any of these properties are sitting on the market or having high vacancy. We've gotten them all rented out very, very fast. It's currently worth $270. I know that's like, you just bought it 2 months ago and you're saying it's worth $270. Again, we got this under contract 6 months ago, right? And then we had to wait for it to be built. So the vast majority of that equity gain has happened while we were waiting for the home to be built. And then literally just a couple of days ago, like a week ago, we closed on a house for my sister-in-law, Christy's sister. This is something I probably would not have considered before reading a really great book called Die with Zero, which changed the way that I look at money and wealth building and contribution. And anyway, this is Ashley and her 3 kids. They actually live with us currently, and she just couldn't really afford a single mom, and she couldn't really afford a traditional rental anywhere in the area. And so we asked her what she could afford. which was about 1,200 a month, and there's really nothing for rented for 1,200 a month. Not at least nothing big enough for 3 kids. So we had another situation where the sellers of this home were our clients. We helped them buy the house a year and a half ago, and they decided they want to move. They don't like not having seasons. They miss this cold and snow for some crazy reason that I can't possibly comprehend why you would miss that. But they wanted to move to Michigan. And so I went and met with them and I said, "Hey, here's the deal. The market's super hot. Your house is 330. If we put it on, it's worth about 330. Here's the comps. Here's why it's worth 330. But honestly, we could probably get 340 because of how insanely crazy the market is right now. Like that, maybe even 345. Like that just we'll get a buyer who will waive the appraisal contingency. There's nothing for sale in your area even below 350. It's just a small little 1,200 square foot house, but there's just nothing available in that area where this house was located, for that low of a price. So I said, "Hey, the comps are 330. If you want, I'll buy it from you for 330, and I'll waive all contingencies, no inspection, no appraisal." Again, I just helped them buy the house a year and a half ago, so I had a good idea of what the issues were with the house a year and a half ago. I mean, I looked around, of course, and did a walkthrough, but I wasn't overly concerned. They had just replaced the water heater and the air conditioner, so the big ticket items were taken care of. So I waived all contingencies. Or we can put it on the market and you might get more, but we're going to go through inspections and we're going to go through appraisals and we're going to go through all that stuff. And they said, "Yeah, you know what? We've got 4 dogs. We don't want to deal with all that. We'd love to sell it to you. And we feel good that you're going to let your sister live there and all that stuff." So anyway, we ended up buying this house for 330. We did only put 10% down, again using Mountain America's unique program. We lose $300 a month on the property. The best part is that there's literally a model match on the next street over that just closed while we were under contract. I feel sort of bad, telling them 330 because one of the pending comps that was listed at 330 ended up closing for 350. So a decent amount of equity in that property already. We haven't bought it yet, but our next purchase is hopefully going to be a family cabin that we will also turn into our first vacation rental. Basically, I grew up in, well, until I was 12 years old, grew up in Salt Lake City, and my grandpa owned this unbelievable cabin up in Big Cottonwood Canyon, almost sort of on your way to Park City. And it was a very important part of our family. It wasn't just this building. Like, we did all of our family reunions and get-togethers, and I have so many unbelievable memories there. And so it's been a lifelong dream of ours to get a family cabin, and that's going to be our next purchase. That'll be our house number 10, and we're hoping to buy that here within the next couple of months. And our plan is to turn it into a vacation rental. That'll be our first experience owning a vacation rental. Book it out for the weekends that we want to use it, and see how it goes renting it out when we're not using it. And my hope is that we can make a little bit of money renting it out. But even if we just broke even, or even if we lost a little bit of money, I feel like it would be worth it for us to be able to kind of continue on that Jencks legacy of owning a cabin. So a couple things I want to point out. Number one, owning rentals and buying rentals has really multiplied my business. I get so many more opportunities to work with investors now. I used to have kind of this story in my head that I didn't like working with investors because they didn't want to buy a deal unless it was, the deal of the century, or if it was, so far below market value. And we all know you can't get a deal under market value right now, unless you're just lucky and you've got some sort of insane off-market property, which are few and far between and hard to come by. But I've actually found, what makes you want to know what makes these deals the deal of the century. Anything that you've bought in the last couple of years has turned into the deal of the century. Combine that with the fact that you were able to buy it at a 3 point whatever, or even a low 4s in the rates for non-owner occupied property. That makes it the deal of the century. You don't need to get a house significantly below market value to make the numbers work. The interest rate is what has made the numbers work in many of these cases. And now I've had several investors who bought 3 to 5, one who's even bought 6, one who's got a 5th one under contract with me. And I found that, once I've established a relationship with these investors and they're buying multiple properties, it's actually turned in a much easier way. But really, investors just trust me more now. When you're thinking about investing in real estate, estate and I'm able to say, yeah, I own a number of rental properties, and here's what I think, and here's what I think the best investment opportunity is right now, and here's why I don't like that deal. It's just turning into so much more business and obviously a lot more referrals as well. I would also point out that the cash flow will likely improve on properties over time. You might buy a property initially and you're only getting $300 a month in cash flow, and that doesn't feel like a fair exchange. Like in my mind, man, I put 50 or 60 or $70,000 down on a house and I'm only getting $300 a month. That doesn't feel like a very great trade. But what you have to remember is the 50,000 that you put down is still there. Well, hopefully, assuming the values don't go down, right? And lately they've been going up. So that money's still there. You didn't lose that money. You just tied it up for a moment, almost like you bought a CD, right? You've tied it up at the moment. You can't access it necessarily, but it's still your money. And the rents are going to rise over time. Phoenix, in particular, has seen average rental prices increase by over 20% in the past year. So even if you're not getting amazing cash flow on day one, well, year two, year three, year four, the rents just keep on going up. And I've talked to a lot of investors who, once they get a good tenant in there, they don't want to raise the rents because well, this is a good tenant and I don't want to risk losing them. My philosophy so far has been there are a ton of good tenants out there. And if that person doesn't want to pay fair market rent, then I won't have a hard time finding a new person to pay fair market rent. And at the end of the day, it feels harsh and whatever, but it's a business. And when the roof needs to be replaced or when the air conditioner needs to be replaced, no matter how much I like them as a tenant, I'm the one that has to pay for those things. So I'm the one that needs to be charging fair prices for my properties. So one thing we're possibly looking at is, going into commercial loans to buying a larger stuff bigger than fourplexes, or we might just use portfolio loans and stick with the smaller single family. I've been talking to Christy about possibly our next after the cabin, maybe buying a property that we rent by the room to travel nurses, all sorts of different things that we're looking at. But I promised you a spreadsheet at the end. Now there's two ways. Actually, I'm going to do this. I'm going to do this spreadsheet first. So there's two ways, in my opinion, of looking at how each property is performing. There's your cap rate, and then there's your return on cash. The cap rate is by taking your net operating income. The cap rate ignores a mortgage, by the way. And that's one of the reasons why I don't love it. It just ignore the mortgage payment, not the taxes and insurance, but ignore the principal and interest payment if you have one. You literally just take what the net operating income is divided by the current market value. In other words, what percentage of the value of the property are you getting back in profits each year? And so, as you can see, I've put all of our properties on here. I didn't put Denham, of course, with a negative cap rate. That's the one we're giving to renting to my sister-in-law. But as you can see, these cap rates here, are mostly in the 5s, 4s, 6s. And then, of course, that fourplex that we bought is at almost 10%. And I don't feel like that paints a great picture. A lot of investors say, okay, I'm looking for an investment that I can buy with a 6% cap rate. Most of our money on real estate that we own so far has not been made from the cap rate. It's been made from the equity. But also it looks at what the property's current value is, not what you bought the property for, right? So if you just take Mayapan as an example, it's currently worth $325, but I only paid $225 for it, right? So my money that I have in the deal is significantly lower. So the way that I analyze it, I don't love the cap rate. I don't think it's the best tool to use when you're looking at here's where I think cap rates are really valuable. When you're getting ready to buy an investment and you need to analyze 4 different deals and figure out which one's going to produce the best yield for you, then that's where cap rate makes sense. But looking at, okay, what has my performance been? What is the return on my money? How much money am I making? I don't think cap rates are the best tool. think about when you invest money in the stock market, right? Let's just say that you want to get a 10% return on your money, right? So that means if I think most financial people would say a 10% annual return, pretty decent, right? So you're not crushing it, but you're performing about on average with the market. So if you put $100,000 in, then a year later, it's worth $110,000, then you made a 10% return on your money. And that's how I think about the money. And so that's why I like this spreadsheet a lot more, which analyzes the return on my cash. Now, last time I presented this, people got really confused about how I was running the numbers. I don't know. Maybe I'm the idiot. Maybe I'm not the one running it right. So I added an example line. The red one is not a real property, but this is how I'm going to explain it to you. And if you want these spreadsheets and you want to see how I've set up the formulas, I'm happy to share them with you. But let's just say that you bought a $100,000 property and you put 20% down. You financed $80,000 and your monthly payment on it is $500 and it rents for $1,000 a month. By the way, I think we can all agree if we could find that deal, we would. How many times can you buy that, right? $100,000 house, only put $20,000 down, make $500 a month. That would be really nice. But then, so you're making $500 a month. But let's say that a year later, the value of the property went up by 20%. Okay, so now a year later, it's no longer a $100,000 house; it's a $120,000 house. So my cash, I put $20,000 into the deal. Of my own money, I put $20,000 into the deal. So first of all, I've got the return on my cash from a cash flow standpoint. I'm getting $500 a month, which is $6,000 a year, and that is 30% of $20,000. So I'm getting a 30% return on my money. Because again, my down payment money is still there. It hasn't disappeared. It's still in the equity of the property, right? So I've gotten a 30% return on my money from a cash flow standpoint. But more interesting is the annual return on the equity. See, the value of the property is now $120,000, which means theoretically, if I were to sell it, right, I could sell it for $120, pay off my loan balance of $80, and I've got $40,000 left over. I know, of course, there's going to be some fees and all that, but just for the sake of simplicity, bear with me here. So now I've doubled my money. My 20,000 turned into 40,000. So I got a 100% return exactly 1 year later on my $20,000. Plus, I got a 30% return from the cash flow. Okay, so these are all of my properties, exactly how much I put down as a down payment, how much I currently owe on those mortgages, what my monthly payment is, what the gross rents are, whether or not there's an HOA, whether or not there's a property manager, how much my leftover cash flow is. And you see I've added denim in here at a loss of $342 a month, what the current value is, and then what my annual return on my money, my initial upfront money. So you take Sunflower, right? I put $56,000 down on that house, and it's giving me $485 a month in cash flow, which is a 10% return on my money. So I'm getting 10% back in cash flow on that property. Probably not exciting. It's my lowest cash flowing property, but then the equity, it's one of my best. It has gone up so much in value that I only put $56,000 into the deal. If I sold it, I'd have $216,000. So I got all my money back plus times 3, plus the money I'm making on the cash flow. Now, I did want to point out these 3 properties in the blue. Those are the properties that we paid for with the cash out refinance on our house. Again, our monthly payment went up $200 a month, and you can see the cash flow on these properties, $485, $867, and $935. I got a request to show the formula for the cap rate again, which is you take the current value. Maybe I'm saying it backwards. You might want to pull up so you take the net income, so $16,464 divided by the current value, $325,000, and that gives you a percentage. In this case, 5.07%. So just taking net income. Shoot, sorry, this isn't a real spreadsheet. I thought I could click on it. It's a screenshot of a spreadsheet. So you're taking your net income, you're dividing it by the current value of the property, and that's how you're getting the cap rate. And the net income is calculated by taking your gross income, how much are your gross annual rents, and subtracting all of your expenses, operating expenses for maintenance, property taxes, homeowners insurance, all that fun stuff. Again, the one thing on cap rates is it does ignore the mortgage. All right, property managers, as you saw from our, yes, if you would like the spreadsheet, I'm happy to share it with you. We can, it's a Google document, the Google Drive document. So if I just have your email address, drop it in, message it to me on a DM, whatever, and I will share it with you from Google Drive. So property managers, and I'm sorry if there's any property managers on here. Only 2 of our properties are managed. One of them is out of state. One of them is in state. And as soon as that tenant moves out, I plan on terminating that. Most of our properties have not had any issues. Our property that we've owned for the longest, Mayapan, we've had that property rented now for over 10 years, 11 years. We've only turned over the tenant 2 or 3 times. We've only had like 1 late payment in the past, however many years. And there have been hardly any maintenance issues. I mean, maybe I've been overly lucky, but now that I don't really feel like I have. I think people like imagine that, oh my gosh, I own this property. Now I'm going to be getting bothered all the time. On average, with all 12 of our doors, I might get hit with, I don't know, 2 maintenance requests per month. Okay. It is not the thing. Now, again, some of our properties are newer, but it's not this thing where I'm spending hours and hours. And again, I don't do any of the repairs myself anyway. Guess what? Neither does the property manager. They're just hiring somebody and billing you for it. They just look up some plumber on Yelp. Okay, and send the plumber out there and then send you the bill and then also charge you for managing the property. My biggest pet peeve with property managers is that I don't like the way they market the properties. I don't like the way they handle the showings on the properties. I don't like the way they handle incoming applications on the properties. So I kind of like doing it my way, I guess. Maybe I'm stuck in my own ways. I'm sure by the time I want to fully retire and I've got 50 doors or however much we eventually have, I will have to hire a property manager, but I might just hire an employee. That's really my goal, to be honest with you, is once I get enough doors to where it is really taking too much time, I will just hire a person who works for me and make sure they're doing it my way rather than hiring a third party company. Now, what do I do to make sure that we're, doing it right? I do have a lawyer, a flat fee lawyer, by the way, in our area who's really fantastic. And he helps put all of our properties into an LLC. So once we close on it, I just send him the address. He forms the LLC and files the paperwork with the county to make sure that it's, the LLC is recorded as the property owner. There is a little bit of something you need to know about doing that. Your mortgage, if you're going to get financing on the property, the mortgage does have a clause in there that most likely says that if you transfer title on the property, that the entire balance is due. So you're running a risk by putting a property into an LLC because the lender could say, hey, we didn't authorize you to transfer title on the property. You now owe us $150,000 that's due on your loan. But the reality is, from what I've seen and from what my lawyer advised me, lenders aren't really doing that. As long as you keep sending in the payment, they don't care. But just make sure you get legal advice on that before you switch. But each of our properties is in a separate LLC, and all of those LLCs, I don't know the legalities of how it works, but the lawyer who does this for us is also our trust. The attorney who helped us put together the trust. And so he set it up so that all these LLCs are somehow under the mothership of our trust. We obviously have a professional accountant who helps us with all the tax filing stuff. I use a website that's, I think, $100 a year called eForms, which lets me send out legal notices. Like if I've got someone who hasn't paid their rent and I need to send out a 5-day notice to pay or quit or whatever it is, they have templates for all that stuff, and it's very inexpensive. Lastly, I use a website called Rental Hero, where I track all the income and expenses on each property. And whenever the rent comes in, I log it. Whenever I have to pay a repair or HOA or anything, it all gets logged in there, and it creates a P&L statement for me on each property that I can just print out and give to my accountant. So very fast and easy. One thing to consider, even if you want to invest in Arizona, or if you don't want to invest in Arizona, some things you should look at is how landlord friendly is your area. Arizona is considered one of the most landlord friendly states in the country. First of all, our property taxes are one of the lowest in the country, an average of 0.72%. And it's also very easy to evict tenants if you need to do that. I have not had to evict a tenant so far. I'm sure we will get to that point eventually, but only 5-day notice is required to tenants who are late, and you issue a 5-day notice to pay or quit. 5-day notice required to tenants who failed to maintain their the property. A 10-day notice to someone who has violated their lease agreement. So pretty easy. And I did get another question, and it was, why didn't I just buy the properties in the LLC in the first place? If you're getting a Fannie Mae or Freddie Mac mortgage, a traditional conventional loan, you cannot close in an LLC, at least not that I know of. You have to close it as a primary person, and then afterwards you can transfer it. If you're going for a portfolio loan, which is what a lot of real estate agents do, because it's hard. If you've tried to get a normal, traditional, conventional mortgage, you know how difficult it is when you're self-employed. Now try adding in that you own, 8 or 9 rental properties on top of it. It gets very, very difficult and complicated to qualify for a traditional mortgage. So you can do portfolio loans that will allow you to close on an LLC. But thus far, all of our properties have been conventional mortgages. And I like them because they have the best terms, right? They've got the best rates. You can get portfolio loans, but you're going to pay a higher rate. So if you can get a traditional conventional mortgage, that's the way to go, in my opinion. And you cannot close in an LLC. Or if you know of someone who will let you get a conventional mortgage and close in an LLC all at the same time, let me know, because that'd be awesome. If you are interested in, I didn't think about this, I guess, well, hopefully you're watching this on a computer screen and you might be able to scan this, but if you're watching on your phone, you probably won't be able to scan this QR code, but we have a URL there at the bottom, or I can also send it to you. If you would like to get some information from us occasionally of good investment opportunities, I usually like to do a screen share. I create a video. When we did this class last time, I did a video and I sent it out to the people who were interested, saying, hey, this is what I personally believe is the best investment opportunity in our market right now. And we've got several people that we're working with on these new construction homes that I'm recommending to most of my people who are interested in investing in our market right now. So if you're interested in that, please go on there, fill out that form, and we'd be happy to send you that information. Lastly, hopefully you're already on Resilient Realtor, our Resilient Realtor Facebook group if you're watching this, but we would love it if you could go on and like or join or become a member of our Resilient Realtor group. So that is it. I'm going to stop my screen share here and open it up for questions. Let me get back to, all right, there we go. So I am back. And let me just see, I want to see if there are any other questions. Christy, I'm sure you saw from the screen share, Christy has been texting me whenever somebody has a specific question. Cap rate, I don't know. Christy, have you seen any questions that I didn't address? I'm scrolling through the list of all the questions. It looks like most of them are, oh, this one I don't think we answered. Did you pull money out of IRAs or 401ks for down, or strictly from real estate income? So the first 3 properties that we bought was from a cash out refinance on our primary residence. We are with eXp Realty. We made a lot of money on the stock. So our next couple were all financed using the sale of some of our stock, which, the downside to selling stock is that, of course, you're going to have to pay a pretty hefty capital gains on that. So make sure that when you're, considering selling some stock, if you've got a gain on it, make sure that you factor that in. We did not pull money out of IRAs or 401ks because we didn't want to pay the early withdrawal penalty. I like the idea. I have not done it. I like the idea of owning a home inside of an IRA. I don't know if anyone in here has ever done that, but if you have enough cash in your IRA, self-directed IRA, there is a way that you can actually own the house inside of the IRA. You probably don't want it. There are some really unique loans that you can do where you put 35% down from the IRA and then finance the house. But I don't think I think it'd be so complicated because all the payments have to be made directly into the IRA. Payments for maintenance and payments for mortgages and all that have to be paid out of this IRA account. It's a little complicated. I would only do it if I had enough in the IRA to pay cash for the property. I don't know if anybody else has any other questions. If you do, and you haven't had a chance to ask them yet. It looks like somebody did just ask a question. So thank you, Lisa. Lisa Lang asked if I have pulled. I think there's a way that I can put this. Oh yeah, show it. All right, cool. I'm learning how to use this stuff. Have I pulled cash out of any of my investment properties? Sorry if I missed that info. So far, no, I have not pulled any cash out of any of our investment properties. It is something that I'm considering. We have a pretty high amount of equity in a couple of the properties, and I think that it might be wise to leverage some of that money into buying more properties. But I also don't want to significantly weaken my cash flow position. Christy, Christy just said, I'm trying to talk her into that. She's a little nervous about, over leveraging. We're trying to, I don't want to be so overly conservative that we're just, paying cash for everything, kind of Dave Ramsey way. As you know, I love Dave Ramsey's Get Out, but I from a wealth building standpoint, I don't know if I love it as much. So, but I also don't want to be so overly aggressive that we hit a hard times, or we hit another COVID 27 or whatever it ends up being, and suddenly no one has to pay their rent again. So I'm trying to find a nice balance of strong positive cash flow and leverage. But as you know, we have really a ton of equity in a couple of the properties, and I am considering the possibility of pulling some cash out. Again, we have all conventional mortgages on these properties, which means that I have incredible interest rates. So I'm a little, having bought them all within the past 2 years, to do a cash out refinance on a non-owner occupied home, you have to do a portfolio loan. The convention of Fannie Mae, Freddie Mac does not do cash out refinances on non-owner occupied. So you're going to end up probably paying 5% interest rate on that portfolio loan. So I have a hard time swallowing exchanging my 3% mortgage for a 5% mortgage just to get access to more cash. What I was trying to talk Christy into this morning was to pull more cash out of our primary, because as you know, we pulled that cash out almost 2 years ago, and the market has gone even crazier since that time, and the value is up so much more. We could pull another 150 out, but it gets scary over leveraging. So we're still trying to find that balance. If you guys have any advice, I mean, as long as you're turning it into more, the argument that I'm making is, as long as you're turning it into more cash flow, right? Let's say you pull some cash out of your house and it makes your payment go up by $1,000 a month, but you can take that money and create $2,000 a month in cash flow. It's not really costing $1,000 a month. It's making you $1,000 a month. But what if you fall on hard times, right? What if your tenant doesn't pay the rent, and now all of a sudden you're paying for that mortgage and you're paying for your primary? So again, we're trying to find that balance. I am constantly having a mental debate in my head about how aggressive and not or conservative I want to be. So I would love your guys' opinion on that if you have one. So if you have any other questions, please feel free to send them to me via email or DM me on social media or anything like that. And thank you guys so much for watching. I hope you found it helpful.